This content is for educational purposes only and is not financial advice. Investing involves risk. Do your own research and consult a professional before investing. Hello everyone, welcome back. I'm Oldfish. Today, let's discuss Evolve's recently launched UltraYield series all-in-one ETF, ticker name, EASY. The UltraYield series has been on the market for 6 months now, and both the underlying holdings and the market environment have shifted. I want to take this opportunity to re-examine this product, not just to see if the allocation makes more sense now, but to dive deep into the data and see how its sub-ETFs are performing in the real world. Let's look directly at the latest allocation table. EASY's design logic is quite transparent. It maps 3 major global markets directly to Evolve's 3 core UltraYield ETFs. We can break it down from 3 perspectives. First, the largest component is the US market at 44.9%. This is represented by BIGI, Evolve US Equity UltraYield ETF. Its portfolio consists primarily of the Magnificent 7 plus several high volatility names, such as Coinbase and MicroStrategy, which holds a massive amount of Bitcoin. Second is our domestic allocation, the Canadian market at 30.1%. The underlying asset is CANI, Evolve Canadian Equity UltraYield ETF. As a local play, CANI leans into domestic giants with a heavy emphasis on the financial sector, using a covered call strategy to provide a stable income base for the overall portfolio. Finally, we have the 25% international share. This covers developed markets outside North America under the ticker INTI. It invests in industry leaders globally. As part of a global asset allocation, its role in diversifying regional risk remains indispensable. This setup is largely what I expected. In terms of weight distribution, it's very similar to XEQT. The US takes the lion's share, followed by Canada and then an international allocation. However, as an all-in-one product, there are a few technical details you should notice. First, EASY itself doesn't charge an additional management fee. The fees are collected by the 3 underlying ETFs, which avoids double dipping. Second, and most importantly, is the strategy. BIGI, CANI, and INTI all utilize a 50% covered call coverage, specifically writing at the money calls. This means they sacrifice half of their potential upside in exchange for high cash flow. Additionally, these ETFs carry approximately 33% leverage. So, EASY is essentially a leveraged portfolio that has traded away a significant portion of its growth potential. Currently, EASY pays out twice a month, with a distribution of $0.31 per share. At current prices, that puts the yield at roughly 30%. If we look at the components, BIGI yields about 38.84%, CANI is at 21.13%, and INTI is at 27.34%. Weighted together, it lands right at 30%. This confirms that EASY is using a full pass-through strategy, distributing all dividends from the underlying ETFs without retaining any earnings. So, is EASY worth buying? Ultimately, that depends on whether the 3 underlying ETFs are worth holding. Because these are highly concentrated portfolios and the covered call overlay requires active management, we have to look at the data to judge the performance. For BIGI, let's compare it to its peer, HHIS. Over their shared tracking period, BIGI's share price dropped by 22.39%, while HHIS fell 18.52%. Including dividends, but without reinvestment, BIGI's total performance was minus 7.32% compared to minus 6.3% for HHIS. With dividend reinvestment, BIGI was at minus 8.54% versus minus 7.38% for HHIS. Given that BIGI employs higher leverage, it's understandable that it would take a larger hit during a downturn. Now, looking at CANI, the situation is a bit more complicated. The Canadian market has actually performed quite well over the past 6 months. However, looking at price alone, CANI returned minus 4.98%, while its peers ECHI and HHIC returned 13.7% and 10.08% respectively. Even including dividends without reinvesting, CANI's return was only 5.06%, far below ECHI's 22.24% and HHIC's 17.62%. While I'm sure Evolve has its own long-term methodology, their short to medium-term stock picking and rebalancing haven't quite measured up to 9point or Harvest. In my opinion, Evolve really needs to step up their game here. Finally, let's look at the latest changes in holdings, which reflect the fund manager's outlook. In CANI, they removed Thomson Reuters and added CNQ, Canadian Natural Resources. I think this is a solid move. With the volatility in oil prices caused by Middle East tensions in early 2026, the manager is clearly embracing hard assets, using the certainty of the energy sector to hedge against geopolitical risks. In BIGI, they've added pharmaceutical giant Eli Lilly, which diversifies the portfolio slightly away from pure tech. But the core remains the same, the Magnificent Seven, Palantir, and nearly 20% crypto exposure. Given that Bitcoin has bounced back from the $60,000 range to over $70,000, if you are still bullish on tech and digital assets, BIGI might not be a bad idea right now. To wrap things up, I want to give you a sincere warning about the risks involved here. While Easy diversifies geographic risk by combining different ETFs, it is important to realize that the underlying structure remains unchanged. It is still a product built on 33% leverage and 50% covered call coverage. The strategy Evolve uses for this UltraYield series is exceptionally aggressive. Although many ETFs claim a 50% coverage ratio, the devil is in the details. Most competing products, such as those from Global X, typically write out of the money calls, which essentially leaves some room for the NAV to grow. They use dynamic coverage. Take a well-known fund like ENCL. Its coverage ratio fluctuates based on market volatility and often stays well below the 50% cap. Evolve is different. They stick to a hard 50% coverage and write at the money calls, meaning they almost completely sacrifice the upside on that half of the portfolio in exchange for immediate cash flow. Let's do some quick math. If an ETF's NAV drops by 50%, you normally need a 100% rally to break even. However, because the covered call strategy caps half of that upside, the underlying assets would actually need to surge 200% just for your share price to recover. This deep hole effect is very real in volatile or downward trending markets. Then there is the 33% leverage. Evolve likes to emphasize that you still retain 66% of the upside, but what they don't mention is that you are facing 133% of the downside. This extreme aggression is the true source of that 30% yield. It is liquidity bought at the cost of high risk. Of course, risk and opportunity are two sides of the same coin. We are currently in a market adjustment phase, and perhaps only after weathering this storm will we see the true value of the Evolve UltraYield series. If you do plan to allocate to this series, my advice remains: strictly manage your position sizing and utilize dividend reinvestment to average out your long-term costs. So, will you be buying into Easy, or are you going to stay on the sidelines for now? I'd love to hear your thoughts in the comments. That's all for today's video. If you found this video helpful, please give it a like, share your views below, and don't forget to subscribe to the channel. I'm Oldfish. Thanks for watching, and I'll see you in the next one.